So who's calling it a bull run? It's a bull run if you started in March 23rd or 26th of this year.
Correct.
But you can't have these companies without profit trading at 20 and $22 billion market cap. Nothing is never in and nothing is ever out. It all depends on a mixture, not only of price, but the management also learning how to deal with being listed. That people are upset with China, and India separately is doing well because there are 42 or 43 mutual fund companies.
Yeah.
And if you see the tail, they have no reason to exist. Neither their performance is good, nor their brand is some great fund management brand. Neither is their fund manager having a lot of history, but is nearly guaranteed to lose money if you react to news. सबको सब कुछ पता है, and वो information सबको मिल गई है, उसकी value ही नहीं है. Value है, उसको interpret कैसे करोगे? That equity market will beat everything else. That means when markets are bad, you're not supposed to leave.
Everyone to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I am the founder and CEO of Daulat Wealth Management. Today, we have a very special guest on our show, someone who doesn't really need any introduction. He has been doing this for over 30 years. So, yet I'll do my best to do justice to that. Please join me in welcoming Samir Arora to the show today. Samir, it is a pleasure to have you on our show.
So thank you very much. And we hope that we have a good conversation so that your viewers enjoy it. Thank you.
Samir is the founder and main fund manager at Helios Capital. Prior to founding Helios Capital from 1998 to 2003, Samir held the position of Head of Asian Emerging Markets at Helios Capital Management in Singapore. And prior to that, headed the company's Indian mutual fund business from 1993 to 2003. During his tenure at Alliance Capital, Samir's India-dedicated mutual fund garnered significant attention, receiving over 15 awards, including a prestigious AAA rating from Standard & Poor. Samir's expertise and astute investment strategies have been consistently acknowledged by the industry and media today. The Helios Strategic Fund, which he has managed, was nominated for the Best India Fund by Eureka Hedge Fund multiple times and won the award on 4 occasions. His academic background is equally impressive. He went on to earn an undergraduate degree in engineering from Indian Institute of Technology in Delhi in 1983, and went on to complete his postgraduate and diploma in management from Indian Institute of Management, Calcutta in 1985. In 1992, he pursued a degree in Masters in Finance from the Wharton School of University of Pennsylvania, ultimately receiving the prestigious Dean's Award. Join us as we delve into Samir's industry's experience, his wealth of experience, and how we can all learn from what's happening in the market today. So, Samirji, let's get started by obviously, I think the obvious, the markets are at an all-time high right now, but I think it is only really breaching the levels that it was achieved approximately 18 months back from October, September of 2021. So obviously it is a very euphoric movement. We are seeing a lot of interest from retail investors and foreign institutional investors alike. From your vantage, what is your reading of the market? Because again, typically we have seen with our little experience that we have in dealing with investors, they want to book profits at this point in time, yet somehow the thing is to stay invested. What is your advice? What is your view of the markets at this point in time?
In a big picture sense, there is no discussion. We have to remain invested and add to investment. So let's see big picture. Big picture, if you look at last 5-year returns for the index, they are in the range of 14.5% per annum. If you look at the returns for the last 10 years, they'll be, by chance, I saw yesterday or day before, exactly 14% per annum. If you look at last 15 years, that is starting from 2008, then they are a little higher because 2009 and all were good years. And if you look at it last 20 years, it will be in plus minus this range. Maybe it is 16, 17% per annum. If you look at now this year's returns for half the year, at the Nifty level, the returns are 9%. So annualize them, whatever, 18, 19%. So it's not out of line from what anyway have been the normal returns of our market in any 1 year. I mean, annualized, because you don't get it exactly in any 1 year. Secondly, if you look at last year, the returns were up some 3-4%. If you look at it in dollar, For 1.5 years, the returns would be zero because last year the rupee depreciated by like 10%. So if you look at it from December 31, 2021, the returns are zero. So who's calling it a bull run? It's a bull run if you started in March 23rd or 26th of this year.
Correct.
So broadly speaking, you are getting this range of 13-15% return per annum. You never get it in any 1 year that return, but over time it annualizes to that. And therefore you move on unless you see 2-3 years of much higher return than this. That happened in many times. It happened in 2006, 7, 8, or sorry, 5, 6, 7, where the index returns would have been 40% per annum for 3 years. So as you go that, you might get carried away, but you can at least say, 3 years of 40% means that much of it will have to be given back. Today, there is no such situation. Secondly, the global world for last 1.5 years was selling India, the FIIs that is. Last 1.5 means not now, but last year and 6 months of the previous year. And they sold maybe 30-40 billion of Indian stocks. During that time, the domestic guys were buying. But logically and reasonably, we can assume one day very soon or maybe already happening that both FIs and DIIs buy, because that is normally what happens.
Yeah.
FIs also normally buy, and DIIs, at least for the last 4-5 years, have been net buyers. So there is nothing that has happened. The market over a slightly longer period, that is 1.5 years, has done nothing so great for us to feel that lock the profits and leave.
Yeah, and speaking a bit specifically about these sectors, obviously we know, I think you have taken a lot of contrarian bets in the past, and you're not really afraid to call out the run up in the valuations that we saw in most of the new age technology companies that got listed somewhere in 2020, 2021, where you accurately pointed out, I think the entry valuation was not really good to enter into most of these stocks. And yet we see in the last 6 to 8 months, I think you have initiated positions in the likes of Paytm and Zomato. What, in your view, or think from a Helios point of view, what has really changed since then? Obviously, the valuations tends to be beaten down a lot, so you get a much better entry price. But from a business perspective, if you want to touch it.
So in the case of Paytm, the business or the fact that they created a brand and a ubiquitous brand and that everybody knows it, it was very powerful. But you can't have these companies without profit trading at 20 and $22 billion market cap. But more than that, to have a sudden spurt of 4-5 times from the last funding round is what I knew that will have to be given up. Because it is not that the private equity guy should normally come and make 5 times in 2 years. And so it listed at whatever, or IPO'd at 2050. We finally bought it at 550. Actually, the low was 400 and some 20 or 30. And the idea was that over this time, because there was a freeze of new funding, so all these newly listed stocks and maybe the unlisted ones also discovered that they cannot do it the way they were doing it, which is grow at any cost. That the market at some point after being around for 10 years as private companies or maybe longer will want you to show progress on revenue and at least a proper business model, that how will you break even and then how will you make money. So in the case of Paytm, after trying different things, they finally came to this model, which according to us makes sense, that they can see the payments going through their app via the QR code thing to many retailers who are otherwise small and whose data is not available to the banks and other lenders. And from the whatever millions of guys that are on this platform, they can lend to the top 10, 20%. They know if one retailer or seller is getting 2,000 rupees from Paytm every day, that we can lend him something where
Correct.
His installment is 600 rupees a day, so that we are still paying him some 1,400 rupees and he's paying the installment on a daily basis. So that looked like a decent business model because there is a need for it. And you are explicitly showing how data is being used in a lending decision. And so things like that. And then they had $1 billion cash. And we said, let's buy. Now, actually, now the stock has gone up a lot. So I don't know, but It has gone up a lot. Similarly, for Zomato, the stock listed at some 76 or IPO'd at
Yeah,
76,
76.
went to God knows, 140 or 50. We bought it at 52. It bottomed at 42. So that time the thing became, on that day, the stock previous day had gone limit up from 42 to whatever, 50 or 52, basically because they said that now they are not going to fund loss-making businesses, and that their investment in Blinkit will be capped at some 700 crore or whatever number it was at that time. Broadly speaking, the lesson is nothing is never in and nothing is ever out. It all depends on a mixture, not only of price, but the management also learning how to deal with being listed. Prior to that, these guys were trying to be very arrogant. That is actually both, but definitely Zomato, saying that we will not do quarterly calls, that basically, you take it or leave it kind of a
Yeah.
situation. The CEO never came at the IPO time to do calls or to meet investors. That was his moment of glory. But after that, the stock market teaches everyone to behave and respect. So, and that business is also not easy to do.
Right.
It is not a business where some third guy can say, I'm coming in and I'll start with this part of the market, because you have to tie up everybody from restaurants to get the customer to get the rider partners. It's not an easy. It's a tech. It's not a tech company. It's a tech plus ultra complicated logistics.
Logistics company.
Because
Fair
you're
enough.
making 20 rupees per order. And the
Correct.
goal is, if I can make 25 rupees, my life will change. So that is a kind of business. It's a tough business. Therefore, it is a good business actually if it works. And then Swiggy is unlisted. So Swiggy can't act tough, because if Zomato stock price does not move, Swiggy cannot go public. It's very simple. So even though they were otherwise till some months ago equal in market share, Swiggy had to back off. It has to actually, at a conceptual level, let Zomato price go up so that it can price itself off that.
Right.
Otherwise, if Zomato is below IPO, how does Swiggy go public so easily, unless they really then cut their valuation? So it was many angles.
So Sameerji, just wanted to switch gears a bit. Obviously, I think where we are seeing a recalibration of sort in the sectors of the economy, right? I think we are also seeing some recalibration in the way the money is flowing into the emerging markets, right? Obviously, I think China plus one strategy, all the big money managers were pretty much overweight into China leading up to 2019, 2020. COVID happened. I think that had taken a lot of beating, but also the recovery since 2023 in China has not really panned out in a manner which a lot of the market participants had actually envisaged. What is your view of the China market at this point in time? It continues to remain the second largest economy, the largest consumer base. So all of those things still go for them. But from an investment point of view, as a manager, how do you view it?
So what I can see is that, over 5, 10, 15, and 20 years and 25 years, China has broadly done badly for the market. I mean, for equity investors. And so people can take it up to a point if they say, oh, now it has become cheap and therefore I'll play for a trading bounce and all that. But foreign investors, and particularly US type, these big endowment type investors cannot, I think, take it. If it looks that part of these returns have been lost because of top-down macro decisions which are aimed at a different purpose. For example, if you say that because Chinese families or women cannot have children or are not having children because cost of education is high, so I will cut the cost of tuition, if the government says, and they made it not for profit. That looks like a random top-down decision, which no individual investor or company official could have figured out. And these things happened again and again. For example, Didi, which is the Chinese Ola, went public, I think, post-COVID in maybe 20 or maybe 21. And it went public at some $16, $17. Check it out on Google. And 1 week later, that company was raided by
Yeah.
ED equivalent. saying that this data of basically me traveling from place A to place B is very sensitive data, and foreign listed companies should not have access to it. And therefore, that company has been taken private, I think, at $2 or $3. And now they're saying one day we'll list it in Hong Kong. So there were many such issues which have deeply upset the foreign investors over and above the fact that they never made any returns. If they had made returns, they would not be so upset. But
Yeah.
don't make returns, and then you are getting targeted or screwed by actions which are not related to competition or general economy. That makes you more helpless. For whatever reason, they are upset with China. The other reason for being upset is that the US system at large, or the US government itself, is becoming strongly taking China as a strategic threat and a competitor, and no longer as a poor country to be helped or an emerging country to be helped. And that is why they are putting India on a pedestal, the system, to say that we have another country which is like our new friend, which we should enjoy. But I say that our investment story cannot be only that people are upset with China.
Yeah.
But it can be that people are upset with China and India separately is doing well.
Doing well.
Then it makes easy, it doesn't need some difficult thing of investors saying, yeah, but just because I have no choice, I have to come to India. No. India is doing well. So anyway, you should have come. But since you were too lazy to come, now separately China is doing badly. So now you better come. So it's this combo which I think people are accepting or have accepted or will accept, because India's returns have been very good in the last 20 and 25 years. We are number one in the world, not literally against every country, but against the big pools of money, which is US market, Europe, Asia is Japan, China, emerging markets. Against all of them, Indian market in dollar terms is number one for 20 years and 25 years, and number two after US for 5, 10, and 15 years. So our story should not be that this is the best time to invest in India, this is the golden era, because then it looks that as if previously the market was not doing the market. It is that we were generally doing well, and now we have more masala to show you that we should continue to do well. And then maybe you have higher confidence that we will do well. But hey, our market was already doing well all our life because we had these great companies. We were a great bottom-up story. And now with those bottom-up companies, we also have good macro story of, our inflation is in control, the currency or the current account deficit is a bit less. We have digitalization. We are beneficiaries of China plus one, both from stock market flows, but also from these supply chain kind of guys. Then the story is complete. And that is why people, I think, are bullish. And plus, we have more volatility because now we have a domestic pool of money. So it can, if you sell, there is somebody who can buy. It is not totally driven by FR. So things like that. So it's all adding up.
So just sticking to Asia, just one last piece of thing that we wanted to understand. Obviously, I think what's really happening in the Japanese market, right, over the last 6 to 8 months, it has sort of been a renaissance of sorts. Obviously, I don't know if something fundamentally has changed in the Japanese economy that to show the kind of performance that the equity markets has the performed over the last 6 to 8 months. What is your reading of the
one thing
Japanese markets?
Could just be that the Japanese guys did not increase their interest rates. So the Japanese currency has depreciated like mad. I think it's depreciated 15% in 1 year or less. So, when the rest of the world has 5-6% interest rates, and Japanese guys say our interest rates are still, I think, minus 10 basis points or something like that, then obviously the speculation will converge there. And in dollar terms, they may not have done as well as they have done in local currency terms, because the currency has depreciated. So same thing happens in any market. In India, if you depreciate the currency, the foreigner may not make as much money, but the local on paper inflation or just the markup of those assets goes relative to the world. And second is that sometimes some of these things, they have been in a funk since 1989. So someday they have to do well. It's just
Yeah.
a cycle, and it may be driven initially by speculation, and then somebody will say that I am buying it at a 28-year low or something. And so it goes on, and then it becomes that, oh God, it's so much part of the index and I don't have it. Who knows? But it's not something great long-term thing that is happening there,
Right.
because
Yeah.
there is no life in that economy, because they are not opening themselves to immigration, and they are going old every day. So beyond a point, what can do well there in such a sort of a dull economy in that sense?
So switching gears, Samirji, a bit and talking specifically about Helios, right? I mean, finally the firm got its approval to launch its mutual fund business in India some time back. What, from your point of view, I think you think
We
Helios will
haven't
do
got it.
differently?
We
Haven't
haven't
got
got
it.
it. So
Okay,
what we've got is in principle approval,
full approval.
which then basically, once you get in principle approval, you're supposed to invest the money and hire people and do the compliance officers and manuals and choose between CAMs and Carvi and where your servers, and all that we have done. So now we are waiting for the license.
Okay,
So
so
once you get the
that,
license, you're ready.
yeah.
We are hoping to get it sometime, maybe next 30 days or 60 days, but not 5 months. After that, in 2, 3 months, we can launch.
Okay, so how
So
do
our
you think
difference
what
is,
differentiation would be?
so the difference is that we are primarily driven by fund managers and not by businessmen looking for diversification. We are not doing it because we have done already steel and cement and now we need financial services, or that we have clients coming for something else. So what to sell them? Oh, I can sell you a mutual fund. We are active fund managers and we have performance which is a bit good. And therefore, we are doing it from a point where we are going to do only active management. And we are only going to do, at least initially, only equity. And we are going to sell our performance and history.
Okay, got it. I think, yeah, definitely. I think it looks like a crowded market, but I think the under
It is not
penetration is
crowded.
such.
It is
It is
not
not
crowded.
okay.
It's not crowded because there are 42 or 43 mutual fund
Yeah.
companies. And if you see the tail, they have no reason to exist. Neither their performance is good, nor their brand is some great fund management brand. Neither is their fund manager having a lot of history. But the other 15, 20 guys are good. The bigger guys are, because they have now become big also. But the market is relatively, like, if you start and say it's from 2016, it's like 6, 7 year old history. If you look at the previous life, Alliance Capital, where I was the first employee, we were not having any domestic partner. And we were competing with all these big guys like HDFC and ICICI and Birla and Templeton, who all had big foreign brand names, plus also had domestic partners and therefore a starting connection of the public with them. But by 2003, we were India's biggest mutual fund company in equities. And I was India's biggest mutual fund manager in equities among all the new guys. That means excluding the UTI and all who were always at that time the biggest. So it was done. Of course, now we can't do that rank kind of thing because the big guys have become very big in 15, 20 years. But in flows, you can have a fair share of new money, because when we'll show our performance is a bit different from everybody.
The retail investor also tends to be a lot more volatile compared to, let's say, an institutional investor that would be investing with you in a PMS or an AIF.
Actually, I don't agree with that. Actually, the institutional investor is being run by an individual who's in charge of that allocation. So it depends on him also. We have seen the biggest endowments redeeming in 2008 and some other endowment saying to somebody that this is my time to invest. It's all the same. Individuals are the same, right? Even if he's working in a company, it depends on his style. So over time, the advantage of retail is that because there are, over time, you might get millions of them or lakhs of them or whatever, millions of them, that over time, that has a lot of value. The granularity has a lot of value, actually. somebody who's managing money for 10 guys is every day subject to the mood of those 10 guys.
Right.
So it's who knows? It all depends. Basically, if we can do well, they should stay. If we do badly, it is better for us if they don't stay, because then there's less pressure on us because the guys left and take. But broadly, we have done well all our life, starting from 95. So we are confident of that.
So maybe that's a good point that you mentioned that would segue into my sort of like the second last question, where obviously I think investors today, primarily retail investors, have so much access to news. There's this fire hose of information that they have access to where they can constantly try to, make a judgment call or make an investment decision based on, let's say, what they are hearing currently, us talking, or what they hear on the news, right? Yet we intuitively know that's not a very good strategy to stay invested in the markets. And that's something that we typically like to sort of like deal with. So what would your advice be to those
It's nearly
investors
guaranteed
who
to
want to
lose
stay
money.
invested?
It is nearly guaranteed to lose money if you react to news. So I'll explain in one line. That let us say that before the event of some result or something, now the trading is going on. In theory, because the guy, suppose the HDFC Bank result has to come in 10 minutes. Now, right now, the volume of trading will be very high. But why will somebody be trading 10 minutes before the result? That means the buyer is thinking, assume everything else constant, then the results will be good or better than expected. And the fellow who's selling 10 minutes before the results is thinking that the results will be bad. Correct? Otherwise, why are you selling? Right? Now, 1 minute or 5 or 10 or 20 minutes after the results are out, now everybody has that result. Does the volume of trading go down? No. Actually, once everybody, now obviously they're not trading for next quarter will be bad. Now they're just reacting to the what
Right.
happened minutes ago.
Correct.
Now the guy who's selling is saying, oh, I was expecting a good result, suppose, and it has come. Now I should take my profit. A new guy will come in and say, I was waiting for this result to confirm that the result is good. So now I can buy. Point is, still you're speculating after everybody has formally got the same information.
Yeah.
Previous 10 minutes before, you could say somebody's thinking this, somebody's thinking that. So it is obvious that not everybody makes money, because even after the event, is it a good result or not good result? Because somebody is selling, somebody is buying. So we say that these days, the value of information is nearly zero. It is only how to interpret the information. For example, everybody knows that at 2,000 rupees Paytm was making losses, and let us say that they were being arrogant. Somebody said it doesn't matter. We said it matters. You have to pay respect to the market. Everybody has a view, but it's not that only I knew that these guys are acting like this, and somebody else said, no, I didn't know this, otherwise I would not have bought it. Everybody knows everything.
सबको पता है.
सबको सब कुछ पता है. And वो information सबको मिल गई है. उसकी वैल्यू ही नहीं है. वैल्यू है, उसको इंटरप्रेट कैसे करोगे? हम कोई भी कौन सा स्टॉक है जिसमें हमें कुछ एक्स्ट्रा पता है? अब HDFC बैंक हमारी टॉप होल्डिंग है. अब हमें वो 25 साल से टॉप होल्डिंग है. अब उसमें हमें नई चीज क्या पता है, लेकिन हम कहते हैं ठीक है, दूसरा बंदा कहता है नहीं ठीक नहीं है. That is the view. It's a view story.
That's a very humble point, I think, that you made,
right? That is why it is a zero-sum game in trading. Because in a futures market, in a cash market, what happens, you buy it and you hold it for a year, the whole market goes up 10-12%. So you will go up 10-12%. But if you go more, you outperform. If you go up a little less, you would still be up most of the times if the market is up. In futures market, which is similar to this trading on an event, it need not be actually done in the futures market, could be done in the cash market. But if you're trading very fast, you are basically betting against the other guy. So both cannot win by definition. In futures, both cannot win. It's just the way the market is. And therefore, half lose or half gain. In the end, we find that 90% lose and 10% gain. But everybody had the same information, more or less.
The final question, Samirji, to you, this is something that I ask all my guests, obviously, given your decades of experience in the industry where you have seen multiple market cycles, right? I mean, that experience is really important, where you have seen both the peak and the trough. what advice would you have to investors who are just getting started in the markets at this point in time? Or let me put it other way. What advice you wish you would have received 30 years back when you got into this money management business?
So no, I was, it worked for me literally by chance or whatever. But in general, you have to believe in two things and you'll be all right. Number one is believe in equities, not necessarily a stock, but in equities as a class. There is no way that there should be any doubt about the fact that over time, equities will beat everything else that you can do with the money with that style. Now, if you are a guy who converts raw land into get some approval, you might make more money. But broadly speaking, equity shall beat debt. Equity shall beat gold. Equity will beat real estate for regular guys. It's given. Now, the question is, equity beats debt by what is called equity risk premium, which is some 5-6% per annum. But nothing in the market happens evenly. That means the 14% return per annum, you are not going to get a single year which is between 10 and 18%, suppose. It will be minus 20, then plus 10, then minus 30, then plus 30. But the point is, over time, it lands up that it follows the underlying earnings. That also I can prove mathematically to you, but leave it for now. Therefore, once you accept it, that equity market will beat everything else, that means when markets are bad, you're not supposed to leave. You can pause if you're under pressure, but broadly, you're supposed to add. You don't have to add to the same fund manager with whom you might be upset and not to the same stock, but you don't leave the market. So if the original market is going to beat everything else and you buy it on a correction, by definition, your new money, because the old money has to recover everything, that means the new money will return even more. And even the old money's return is generally the highest because you take any point to any point slightly longer, 5-7 year, equity would have beaten more or less everything. So, and the second is believe in India, because India has actually done well for 5, 10, 15, 20, 25 years. But anyway, most of the guys in India are investing in India. So that part is easy, but it is a good story in itself because the world is now choosing. So why not Indians? But that doesn't mean that Indians shouldn't invest outside. They should also invest 10, 20% hedging, foreign dollar, this thing. Why not? But broadly, equities is something you have to believe in and take it in. That you're not supposed to leave it so easily or at all.
Great. All right. Thank you so much, Samirji, for this
Thank
insightful
you.
session. I think this was really wonderful. I think hopefully our audience gets to learn quite a bit. I'm sure there's a lot of information that is being floating around, but to have someone of your caliber come and speak to us, I think that is of great importance and value to us. And for everyone who is tuning into this and listening to us on various platforms, please do subscribe for more such episodes. Thank you.
And may they all make more Daulat.
Definitely. Thank you.
Okay.